So the focus in the market right now is interest rates, and the Fed restricting the asset buying program. So first of all, just to understand what the Fed is, it's the Federal Reserve Board, and it's really a private entity. It's not a part of the government. It's a private bank that lends to our government and our economy. And they have two responsibilities. It's to keep stable prices, fighting inflation, and to keep maximum employment. So historically, the tool that they would use to do that was to control the Fed fund rates, and that's basically the rate at which banks can borrow from other banks, or they borrow from the Fed Reserve in order to make loans and things of that nature. And the lower, well, actually, the higher the rates, the better the profit margins on loans for banks. But the lower the interest rate, the easier it is for banks to borrow money from one another. And at the end of the day, they have to maintain a certain net cap compliance so they can borrow money at a very cheap rate, which makes them comfortable to lend out more money into the economy and just keep business and employment going and control the price of goods. How they control the price of goods is obviously when they ease up money, people are consuming up more goods, slowly brings up the price. As the prices get too high, which is inflation, these guys, they raise the interest rates, and yet money's a little tighter. People aren't spending as much, and then goods accumulate and prices go down to move the goods. So that's traditionally how they did it. And then during the financial debacle of 2007, 2008, they realized that they couldn't really turn the economy around with just lowering interest rates. It was just going to nosedive us. And having such an aggressive downturn with so much momentum, it would kind of have a rounding bottom to turn the economy around. And it would be way too long for people to be out of work and goods not going. And it would really just destroy the economy. So they, for the first time in history, stepped out into the market and started to participate in our economy, and they did that by buying mortgage-backed bonds and treasury bonds, and some people suspect that they bought securities also, although that's could be a conspiracy theory. There's really nothing that's really confirmed that they did buy actual private securities, but they clearly bought treasuries and mortgage backed securities to help stiffen up the economy. So these guys, so anyway, as they purchase bonds, the price of bonds go up, and it's kind of a teetering effect. As the price of bonds go up, the interest yields go down. So it's a reverse effect. So when you hear that yields are rising, interest rates are rising, the price of bonds are coming down, and that's tightening up the economy. When interest rates are dropping, the price of bonds are going up. So these guys stepped into the market, started buying up to create demand, forcing the price of bonds up, and interest rates down, interest rates low. So now, and keep in mind that this is primarily what kept the economy going. And we're not going to talk about the merits of the program because there are two sides of that. And some say it was a terrible idea, and some say it was a great idea. But nonetheless, this is the punch bowl at the party. And now they're talking about taking away the punch bowl. So that's why everybody's on edge and walking on eggshells and kind of watching what's going on with inflation and watching what the Feds are going to do. And this is why the market isn't consistently going up like it has over the past few years, because the whole economic environment is about to change. And once these guys stop making these purchases, supply and demand turns around. And supply increases, demand decreases, which forces the price of bonds down. So that's what everybody's looking at and what they're going to do. And it's all based on inflation. If we hit, normally they try to keep it at about 2% inflation a year. If we go over that, they start tightening up. It's going to be very aggressive now, inflation, because people are or have socked away cash for the past year, sitting home and not going out and everything. And this summer, everybody's going to party it up. I mean, yet I'm feeling a little extravagant myself, and I'm sure everybody else has cabin fever, and they're going out and just having a good old time. So we're going to get this spike in inflation, but a safe assumption is that that's just transitory. I mean, we may see a little bit of inflation, but the spike is not going to last. It's going to fade out. People are going to mellow out, especially when winter rolls around. You'll have another influx of purchasing when you have the back to school season. But after that, everybody's going to kind of chill out and go to work and kind of just get back to normal. So I think inflation basically will back off. But nonetheless, people are looking at the feds and what they're going to do. And either way, inflation or not, they're going to have to start reducing their balance sheet. They're not supposed to be holding all these assets. They're going to slowly stop the large assets purchase. The other name that everybody's heard is quantitative easing. I mean, it's the same thing. That's the program. The quantitative easing was the purchase of large assets. So these guys inevitably are going to back off of the large asset purchase, and that's okay because the economy is healthy and it's strong and it could stand on its own 2 feet, and it could probably absorb the Fed stepping out of participating in the economy. So that's really what's going on over here. Now, a way to play it is obviously to short bonds, and most individuals don't have the ability to do that, but you could do that with an ETF, and that ETF symbol is TBT, and it's an ETF. I don't know who the proprietor of the ETF is. I mean, that's easy information. You could just look that up. So you could go long that ETF symbol TBT, and that is a short on bonds. So if you want to take advantage of the Fed reducing the large asset purchase or easing out of the quantitative easing program, then TBT is a good way to take care of that vehicle. So if you find my information of value, do me a favor, hit the subscribe, hit the bell so you know when I drop things like this out on my channel, and hit the like button because that does a lot of good for me. And some comments, good comments, bad comments, anything I could do to improve the channel or things you want to see, chat it up. I like to reply to them, so you will hear from me. So anyway, keep your eye on the Fed. Maybe take advantage of a position to make money in that. And good luck with your trading.